right, everybody, welcome to another Learn It Live webinar for, of course, Pepperstone. My name's Thomas Atkinson from FX Evolution, and I'm joined today by Ty and Abella, also from FX Evolution. How are you going, Ty?
Good. Hello, everyone, and welcome to tonight's webinar. Yeah, it's going to be about ETFs and indices and how to day trade them. So a lot of people are really into this and able to trade those sessions. So we're going to look at some of the good ways that you can actually do it. And yeah, probably most importantly, get out by the end of the day, Thomas. I think it's where a lot of people struggle. They can get in easy enough, but they can't get out of it by the end of the day. So we'll certainly jump into a few of those strategies and see if we can get you trading successfully during the day.
That's very true, Ty. It's all about what your entry criteria can be as easy as click a market button, but your exit and stop loss criteria can be the tough points. So quick risk warning, the information provided, of course, in this webinar or video, if you're watching it back on YouTube, is for educational purposes only, and the information does not take into account your personal objectives, financial situation, or needs. This information is, of course, not to be construed as a recommendation or solicitation to buy, sell, or participate in the markets. So Tyron, just a quick shout out, of course, for the Pepperstone Telegram group, Pepperstone YouTube community. So go check out Pepperstone, and also us, FX Evolution. If you want to check us out on YouTube, we've got a decent following there that you can come and have a look at. And we also have a Discord community that will be sharing the links both to the Pepperstone Telegram, one of the best places to be, and of course the Discord community if you're interested. So what are we going to be covering today? Well, Ty, as you said, day trading strategies. The idea of a day trading strategy technically is to be in and out in the same day. We also have live charts and price action analysis that we'll be taking a look at. So we'll be really dialing in here on things like the S&P 500, the NASDAQ, some different types of exchange traded funds, what kinds of things you can be looking for. And then we'll go to key timeframes and entry points, and of course, live Q&A is with our team as well. So if you have any questions, please feel free to ask them. I can already see Ray has said hello. How you going, Ray? Great to have you here. So Ty, whenever we talk about stocks, we talk about indices, we talk about ETFs, it's actually pretty important that we understand the timing and especially the earnings seasons, aren't we? And we are in actually earnings season here in the US. Right now. Earnings season has just started. We've got massive big Apple earnings coming up next week. We're in the midst of Thursday session. We're going to have a Thursday at the close, Twitter and Snap and all these other large companies all announcing. How important is understanding when earnings is coming out to the market?
Yeah, look, that particular period of the year, if you don't know that earnings are coming out, you are trading absolutely blindly, and realistically, it's probably worse than trading news, because you're actually, that news is specific or can be specific to the exact thing that you're trading. So really, really important. Look, it's not hard to find out. Look, we'll probably touch on a couple of sites that you can find out where the earnings are. The events calendar. Absolutely. Like, it's just such an easy thing to do. And a lot of people don't randomly just select an ETF to trade either, right? Like, you don't jump on the stock market and say, all right, I'm going to trade 100 different stocks. Most of the time you've got a little bit of a basket that you're interested in. So it's not too hard to really work out, pencil in, put it on a piece of paper, what date they are actually going to report. And probably the other important thing, which is around the reporting time, is when they're going to pay a dividend. Very, very important when they're going ex-dividend, because an ETF will take the hit of that dividend, as you all know. But if you don't know it, you're going to have a very rude shock. So very, very important to write down the dates, especially at this time of year and later in the year around November time, because that is the earnings season.
We tend to have basically earnings. Obviously, earnings are different in Australia than they are in America. And what will happen is, if you're not aware, like right now we have S&P 500 earnings, as Tyron alluded to. We've got earnings coming in Australia at different rates and different companies come out. And the dividend story is very important to understand if you're trading something like the ASX 200. So if you're looking at trading the ASX 200 and you're thinking, this is the one for me, I like this index, I understand it, I live in Australia, let's just say, or wherever you might live in the world, you may want to consider this. However, you must be aware that there are seasonals that go around earnings as well. And that's something that's unique to that market. In the US, less earnings results, like in terms of dividends. However, the impact on the technology sector, the impact on the overall market can be extreme. We also want to understand seasonal returns when possible, Tyrone. And I think this is something that a lot of people don't understand. I call it, I guess, actionable data. And the whole idea is, if you have, let's say, it's something we discuss in our courses and we're discussing in our community as well, is that if you have a top-down approach to everything in life, and you can actually take the data points to give you a bit of a bias on what's really going on in the economy. So let's say cut down all the noise and really just go, okay, what month are we in? What data points matter? Well, I think the data points that matter are things like this: understanding what has happened in the history of the stock market, in this case, the S&P 500. If we understand what happens in history and which months are good and which months are bad, it gives us a little bit of actionable data bias that we can put together. The other thing that we can then do is we can then break that down to the last 10 years, the last 20 years. Has this statistic held up over that period? Is there some kind of changes that have gone on? Another thing that you can bring together is maybe the idea of which markets perform well at different points. For an example, February tends to be a very bad month for the NASDAQ. So not only is the S&P 500 down generally over a February period, it tends to be a bad month for the NASDAQ, historically worse than, of course, overall, the S&P 500. Now, why is this? There's a lot of different reasons why it is, but overall, the data is telling you that. If the data tells you that and you see a short opportunity on your day trade during the month of February, which you know statistically or data driven is actually a weak month, does that help us, Ty, as traders? I believe it does. What do you think?
Oh, most definitely. It's like a boost up. It's like when you're trying to jump on a horse and you've got a stool underneath you. It makes it a lot easier to get on, right? And it's the same thing. I mean, you're getting a boost for the trade direction that you're going for. I mean, if you're going to try and short a potential stock in September, and then you look at this chart, you say, wow, this is pretty weak in September. And then you dial down even further and you go to that sector that your stock is in and know that it really is down in that sector, then you're getting a double boost. And it makes a big, big difference. Like we're in the trading game, we're looking for every advantage possible. And when the advantages are right there and presented to you, you'd be foolish not to take advantage of them. So they're really, really important. I've got a quick question. I'll answer that on the fly. Charles asks what the ASX 200 is. So Charles, the ASX 200 is effectively the top 200 stocks in Australia as an indice. Okay, so just like the S&P 500 is the top 500 stocks, the ASX 200 is the top Australian 200 stocks. Okay, so it's just an indice based on the top 200 companies. So that's what makes it so stable, because it's not going to be intimidated by one or two moves. It's basically using the data of 200 companies to really form its level. So not easily manipulated and very, very technical.
So another part of that actionable data, Ty, that we talk about in our community, and it's really a big forefront before you even look at an index or an ETF of any kind. And of course, an index is index and ETFs are kind of synonymous, and we'll talk about that a little bit more soon. But yeah, another thing that we want to do is look from a top-down approach. What months of the year tend to be strong for different sectors? What months of the year tend to be strong from not only just the stock market, but other things? This is all about bringing together as much top-down analysis as we can. And you may think, Tom, Tyrone, I only trade the daily, man. I only trade within the day trade. Still, having this bias and seeing it play out with the price action that we'll be talking about in a few minutes, it really helps us to get a very good idea of whether it's good to be in the market or not. So right now, Tyrone, this is the US 500. This is the S&P 500, probably the most popular and well-known market in the world. I wouldn't even say it's it would be. Maybe the Dow at one point was the most well-known. Ty, I feel like it's the S&P right now. What do you think? Do you reckon the Dow is still the most well-known market?
It's probably the most well-known, but I think it is shifting to the S&P. Look, the Dow is known, really because it's the one they use in the movies, and yes, it is, it is very, very popular. But look, you've got to remember the Dow is only consistent of 30 stocks. So the Dow Jones is made up of the 30 stocks that they've got in it, whereas the S&P 500 is made up of 500. So it stands to reason, and common sense would tell you that a better barometer of the actual economy is the top 500, not the top 30. And realistically, this is the one that actually that real traders use, because this is the one that gives you the most amount of information, if you like, at a glance. I mean, this is the top 500 companies basically derived and giving this basically these levels on the US 500, whereas when you're only basing it on 30 of the top companies, now they are the biggest companies in the world, let's not make a mistake there, but in saying that, though, you can see that you can have a significant impact. Let's just say, for instance, 3 or 4 of those top 30 have a very, very bad earnings. It's going to have a significant impact on that particular industry. But does that really play out to the top 500 companies? Do companies 500 to 250 care about, you know, what the Dow Jones companies are doing. The ground level companies are the ones you probably, and when I say 500, it sounds like a lot. It's actually nothing compared to, yeah, how many companies there are in the US, by the way. Like the Russell 2000, there's got 2,000 companies in it. So as much as 200, ASX 200 companies in Australia is a lot. Okay, so if you're covering the top 200, you're covering probably the majority of any companies that have any significance on our economy. But the top 500 is actually just a number. There are a lot more companies than that. But when you're talking, yeah, to be in the top 500, you have to be a very, very, very big company in the US. So it's a very, very good barometer of how the economy is actually tracking. And in my opinion, definitely more valuable than the Dow Jones 30, even though they do mimic each other very, very closely.
So Ty, we're here on the S&P 500. And I think something happened really interesting yesterday, and that was that we have a few moving averages here, and we've been asked here a question about this. They are the 20 exponential moving average, which is the red line. They are the 50 exponential moving average, which is the blue line, and the 200 simple moving average, which is the green line. We always use these. There are very good reasons why we do use them. If I was to say, and Tyrone was to say, which is our favorite, it's always going to be the 20 exponential moving average. It's incredibly good at being able to, it's like mean reversion, especially on the weekly. So let's just quickly talk through what happened yesterday. So firstly, we sold off. I mean, obviously we sold off, and this was the day before, and we moved down to the 50 exponential. Now, as we were talking about this, and as we were discussing in our community, and as we were discussing on YouTube, etc., this is a level that we were definitely targeting from an action standpoint, because what do we know has happened in the past history? And technical analysis is a lot about this. We had it one time touch over here, it bounced off it. We had it touch over here, it bounced off it. We had it touch over here, it bounced off it. And then of course, over here as well, it bounced off it. Now, this is showing us a bit of a pattern, and a lot of technical analysis is understanding patterns. That, you know, there's obviously patterns that we trade. So it comes back down, hits this level. What is the most likely thing to happen the next day? It's most likely going to bounce. Now, that's just based on what the history of the past. Eventually, it's not going to work like that, but we might see a slightly different scenario. This is what happened. Yep. And it moved up. Is this a good day trading opportunity? It is a great base formation for us to then go inside and then say, okay, can we find a buy opportunity on one of the smaller time frames when we come into the market?
Most definitely. And I think, look, last night was probably a really good example of this. Like we were running the live US market open on YouTube, and there was like 1,800 people in the room, and I can guarantee you that 1,400 of those people were all talking about that 50 level, how they were going to long it for the day. And all of them were right. So we're talking about a very small sample of people. Like 1,500 people compared to how many traders there are in the world is only small. But when you've got, 1,500 odd people out of 1,800 people all talking about longing off that level as a day trading opportunity, it gives you a bit of an idea and a snapshot of the mentality of how traders think. When you're looking at technical analysis, it's a no-brainer to look at that and say to yourself, well, this level has held up, 8 times in the past. It's still making higher highs and higher lows every time it goes up. Why would now be any different? And you continually do that until eventually you are proven that the change of trend has happened. Now, all the way through here, we have not seen a sequence of lower highs and lower lows. And until that happens on a daily chart, this thing is long, and it's going to be long every time it touches the 20 and the 50 moving average until such time as we get a lower high and lower low sequence. That has not happened in a very, very long time. And when it does eventually happen, that's when the correction is going to come. One of these levels testing the 50 is going to eventually cause that. But until that actually happens, we don't trade what we think is going to happen. We trade what we see.
So the next question becomes, firstly, how do we get into this type of stuff? So there's a reason we're sitting on the daily, and that's because we want to bring together as much information as possible. And we'll actually dial in here on a whole bunch of synergies that we saw working out yesterday. So someone said here, what about this trend line up above, Tom and Tyrone? Absolutely. This is a great trend line that we've had set here. I call it the community trend line because I feel like the community knows about it, and we're watching this one every single week, and we've been using this for quite some time, haven't we, Ty? But look, if the market does end up rallying in here, a day trader might come in, see the top of this trend line, and start looking for potential weakness. Now, will you be going against the trend? Sure, but you're also at a point where it's statistically potentially getting more likely there's bearish action. We'll talk about the lightning bolt setup and why we use that up at those types of points. But let's go to the 1 hour, Ty. I want to talk about market open yesterday, because when you're talking about indices, ETFs, this kind of thing, we always want to be talking about how do we get in, what do we see, what kind of sneaky business do we see happening. And I think yesterday was a classic case of a stop hunt. And what I mean by that is that initially the market comes in. We know we have a little bit of resistance up here. We've got a little bit of consolidation coming in. You'll notice there's a low here, and the market initially sells off. So if we go down to the smaller time frame, let's go to the 15-minute time frame here. The market initially sells off into the open. It makes a new low, then fully reverses with a nice bullish wick here, and then makes a new high. Now, when something happens like that, and it specifically takes out the previous low, this is a great opportunity to be able to see, oh, hey, look, there's something going on that's really, really strange here. We've got volume increasing at the same time near the open. We've got a clear level where it's taken out lots of people's kind of stops that are going to be underneath this last low and underneath this last low. And then we've created a full bullish rejection here with a new peak. This brings our sequence in: trough, peak, higher trough, higher peak. Ty, how important is that lightning bolt?
Oh, lightning bolt is everything, Thomas. Lightning bolt's more important than breakfast, and we know how important breakfast is. Without that, you do not have confirmation of anything. Once you get that, the sky's the limit. And I think yesterday was an absolute classic case. You're right. Like, it was absolutely anybody who was actually putting in longs and had a very shallow stop loss, which is a very, very dangerous thing to do at a market open, especially at a market that was threatening to go lower, was going to get taken out. And then there's nothing worse than seeing your position get taken out, and then of course go on to the glory that that it did for that day. So you've got to be really, really careful. Don't look. One of the things that you want to be doing, especially when you're trading a market open, is give your trade the room to actually have a stop loss that is relevant to what you're trying to achieve. Don't be too tight on that stop loss, because if you are, the stop hunters will get you. And there's never more prevalent time for stop hunters to be out and about than at a market open, especially London. But US is just as important.
Here's a great example, Ty, of how, I guess I would have played it from a day trading perspective. I'm a big fan of the bullish hammer, the shooting star, the long leg doji. I love the long leg doji. And of course, engulfs and things like that. We see this false break. We see effectively, which is what, if we had a 10-minute chart here and I could put it on, what this will actually be is it'll be a low, it'll be a high, and the body will be here. So remember, just because, because basically one's a bullish hammer, one's a bearish kind of shooting star, or, 2 pin bars, if you want to call them that way. And it's closed above this point over here. It's closed above the peak at the same time. What this is doing is it's showing us that there was a lot of indecision around this point. There was clearly the stop hunt. There's a lot of volume here, which usually shows sneakiness. And then on top of that, we get that huge market movement above. So basically, this is where we start to see that rally happen, a full reversal switch. And when you have that, it usually leads to quite a lot of decent success. Now, if we think about also bringing together as much as we can as a day trader, let's move over to the Dow Jones before. So the Dow ended up on a trend line. Now, this is a daily trend line, and you can see how powerful this daily trend line's been. So we had the S&P 500 index looking on the daily 50 exponential moving average. Then we move over to the Dow. The Dow is sitting on a trend line that's been holding up since February. Is this painting a picture for us as, hey, maybe we need to pay attention to the bull side here? Now, of course, if the market had gone underneath these lines and had gone underneath the trend line, then we would have been in some trouble, because that would have led to the shorting of these indices. But at this stage, it was basically all on supports, and that looked really, really great. If we move over now to the Russell 2000, which, as Tyron alluded to before, is the smaller cap companies, this is one that we've got trapped within a very large range. Of course, most people will be able to look at that and they'll see it as a hammer. I mean, not hammer, as a channel. And the channel over here has been setting up now since February, March period, all the way to the current period. We've got a huge range in between here. And then we have a ability, if it broke underneath, to be looking for day trades towards the short side. So just remember, on the stock market indices, on ETFs in general, one of the most important things to do is to check your weekly candle, check your daily candle, and then when you see a big change in any direction, you will usually be able to take advantage of that from the perspective of getting in there and saying, okay, if we close underneath this 208, we believe that this is a channel range break. If it does happen, what's the next logical conclusion for it to go the distance? So then you can go into the 5-minute, 15-minute, 1-hour charts where typical day traders are and look for the shorts and the short potentials, because Ty, there's going to be a lot of pullbacks in that way to get down to this point, isn't there?
Oh yeah, no question. And I think, and like we say, that's why we follow the moving averages, because we know the 20 is going to be, look, it's going to be your friend. It was your friend all the way up there, even on this chart here. You can see on the daily, your friend on the way up. It's going to be your friend on the way down. But the most important thing is probably a good answer to the people who were asking about the moving averages earlier. Those moving averages are the same no matter what time frame we're on. Okay, so once they're on a chart, as you shift through the different time frames, they just adjust for that particular chart. So there's no need to adjust anything. You always know the red one's going to be a 20 no matter what time frame that you're on. But they work in the exact same way on a 2-hour, on a 1-hour, or even on a 4-hour, whatever you want. So the pullbacks work the same way. The 20 is the mean reversion pullback. So it's a really, really good way to understand that when we look at a red moving average on a chart, we have, if it's one of our charts, that is, we have no question what it is. We don't even have to think about it. But we know that every pullback on the way up and every pullback on the way down is going to be a potential entry point on the smaller time frame. And I think that's where day traders really need to focus their energies on, especially on those time frames that are relevant, because that's how you're going to get your trade in and out.
Yeah, that's the most important thing you want to be doing there. So look, the Russell also was on support. You can see that and where it closed. So we had the Dow, we had the Russell, we had the US 100 NASDAQ, we had the US 500, all sitting on support at the same time. There's no coincidence that if, when we saw that lightning bolt towards the upside, it's a strongish bullish signal from a technical price action standpoint. If we bring in something like a closure below all these lines, let's think about it. Russell would be closing below the 200 daily, which Tyron alluded to. We would have the US 500 closing below the daily 50. All of these lead to quite a lot of movement through. I just have to apologize. I think quite a few sounds from my desktop are coming through. Sorry about that, guys. If you can hear it, it's just it's one of the chat rooms, unfortunately. So yeah, I mean, basically all of these are strong kind of markets to be looking at. A few people are mentioning the ASX 200 and also some other things that Pepperstone obviously offers on their platforms. And now Tyron said before, one of the things we want to be knowing about is earnings. And I would actually say that if you trade the US stock market on Pepperstone, if you trade any of those indices we were just talking about, NASDAQ, S&P 500, Russell, any of those types of things, you really need to know when the earnings are coming out. I actually really like earnings whispers for this. It's a free thing. You can get it. You can get it in our Discord community. If you're interested in joining up, you can come get a copy of this one. And they basically provide them every week. You can sign up to their little free newsletter or whatever, or Twitter. But yeah, what they do is they provide this cool picture frame, and I like it. So I can easily see all the companies, and then my eye goes over here, and it's like, oh, Coca-Cola, it's Snap, Twitter, Intel. These kind of companies are coming out. What you then can do is you say, okay, well, does this kind of news, is this going to affect the S&P 500? Is this going to affect the NASDAQ? Now, next week when Apple have its earnings, Apple's the biggest stock, give or take a couple of days there. So if Apple has bad earnings, what do we think that's going to do to the NASDAQ? It's going to be bad. So we need to be aware of that news. And if you don't know it and you've ever entered a position and gone, yes, I'm up 35% or something like that for some whatever reason, and you're not sure why, and then you go over and you think, oh, that was Apple news, you've kind of probably made a bit of a mistake, haven't you, Ty? That'll eventually bite you. That won't be that great.
Yeah, 100%. We've got another question here from Theo asking, what account size do you recommend day trading either ASX 200 or S&P 500 or Dow, risking only 1 to 2% per trade? Theo, that's a really, it's a question that basically only you yourself can answer. When you're only trading 1% risk on your account size, the account size absolutely makes no difference whatsoever. You're risking the right amount. For day trading, especially if you're only starting out, you probably would maybe even want to start a little bit lower than that, maybe even 0.5% per trade until you get the gist of what you're doing. But realistically, when you're trading, 1% or less as a risk, the account size is really irrelevant because the risk is the same. 1% on a $10 million account is the same as 1% on a $1,000 account. So realistically, it's whatever it is you're comfortable with. But it sounds to me like you've got the right idea because you've got the right percentages of where you're risking per trade, which is actually the most important thing, not so much how much is in the account, okay?
So lead indicators for market sentiment, Ty, when we're trading exchange traded funds and indices, we always want to know where the volatility index is. We always want to know, we kind of want to know usually where copper is. That can be called Dr. Copper. It's usually only good around kind of big crashes in the markets though. So copper becomes less reliable as, let's call it Dr. Copper, until maybe a year to 18 months after a big crash. And we're getting on that point now since the pandemic all began. So at this point, copper is probably less important. But again, remember in the future, if it ever happens and you ever see another crash, which most of us will see during our lifetime, it's just inevitable. When that happens, copper usually is a good precursor of the health of the market. If copper's going up, maybe things are a little bit better than you expect in the back end because copper's very heavily used in industrial rebuilds, etc. And if copper's going down, you might want to pay attention. US dollar is also used, Ty. This is the dollar index. This shows us a bit of a risk on, risk off sentiment. So if the US dollar is rising, the stock market is rising, and bonds are rising all at the same time, usually some of those are correct and one of them might be false. So you need to pay some attention to all of these types of market indicators. All right, well, let's go back into some live examples now and just talk about some different things. So I'll bring up the Pepperstone platform over here and we'll go through some of the offerings on, of course, the Pepperstone platform. So let's have a quick look here on the right-hand side, and we'll just go show all, and this will bring up a lot of offerings. So obviously there's a ton of stocks now. Look at all these stocks that are here, Ty. So many of them, but there's also a whole bunch of different ETFs. So we've got things like the biotech ETF here. We've got things like, of course, the Russell 1000 for growth. Some of these ETFs, which are newly added, they really offer some super cool different types of abilities to pick sectors without having to specifically pick a stock for that sector. So, if you wanted to get into certain bonds, you're not going to go buy a bond. I mean, people don't understand how big is a bond, Ty. Some bonds, they're not packaged in the $1,000 for the mums and dads, are they?
No, that's right.
Yeah. They're packaged in more like the $500,000 to billion, $500,000 to millions.
It's a bit like it's the same as Bitcoin, right? You're not going to go buy one Bitcoin at the moment. Yeah, so it really comes. That's where the ETFs are so good. You get basically exposure to something that is far bigger than just one unit.
So what you can do is you can kind of get a bit of an idea based on some of that actionable data we talked before about. And there's all of these different funds in here. Like one of the ones that's very popular is something like Kathy Wood's fund here, which is ARK. So if we have a look at ARK, we'll just quickly load up our chart over here. And these types of things, they allow you to target specific types of stocks or types of indices that you want to target. If you want to target, well, I guess they call like hyper innovation, you can do so. Sometimes that's going to be the most popular sector in the market. Now, before we shared a bit of an idea of certain months of the year that some sectors might work out better than others, or certain times that might be good. We said that the NASDAQ traditionally is pretty bad during February. If you're trading hyper stocks, as they called, or hyper index kind of positions that are all in tech and they have very high valuations, then maybe February is the month that you might have more of a short bias and you'd be looking for, the trend agreeing with that, the price action agreeing with that, and then of course being able to execute on that type of thing. So there's lots and lots and lots of stuff that's available there. Pepperstone's constantly adding to those. But I just wanted to quickly discuss, people think, Ty, when you're looking at day trading, that it can be that hard, it can be difficult, it can be hard. One of the things that I like to look for sometimes is just to go to the daily and to see stuff that makes sense. I mean, here we have a rejection candle, we have a rejection candle, and we have a follow through candle. When we see two rejection candles, even though it's going against trend, it would have me as a day trader dialing in on this time frame, dialing in and saying, well, is there any potential trade here towards the short that we could get involved in? And what do you think about that, Ty? I mean, sometimes there's just going to be a really great shorting opportunity. And I would argue there was one here. We had rejection, we had a support and a resistance line, and then we closed below. Notice how there's this massive, big bullish wick. It looks like it's the best. Let me just zoom in here on this. I mean, you think that, and you see that bullish wick, and you think, oh, hot damn, that looks good. And what does this have a big problem with? It's a great tip, this one, guys.
Yeah, no, that is just an amazing setup, and the thing is, this is a 2-hour chart. If you miss that one, that is the arrow that we got pointed there. You will not be forgiven for missing that one. You can be forgiven for missing the first one. The second one, you cannot be forgiven for. That is just an absolute short, all day, every day. The price action is telling you exactly what you need to do. It's at the moving average. You've already got basically you've seen the fall, you've seen the lower highs and the lower lows starting to get formed. You've seen the weakness from above. You need to take those trades. That's what trading is. And from a day trading standpoint, look at the results that would have yielded you. Like, that's a role reversal 101, especially when you're getting lower highs from above. And I think this is why it's important. People sometimes tend to think that day trading, you can probably just sort of stumble in there, with your, with your beer on your day off in lockdown, and you can just basically have a couple of trades here and there, like for a bit of fun, like you're at the races. No, you still have to understand your technical analysis. It's actually more important, because when you've got a smaller time frame to work with and you've got basically a fast moving market, it's even more important to understand your levels and to understand the technical analysis and what it's trying to tell you, because quite simply, you haven't got the time to actually make the wrong decisions at the wrong areas. So technical analysis, even for scalping, is actually even more important than it is for the longer term trades. So you got to be mindful of that. Like, it's not about that one candle that we see that is a must entry. It's about what happened at the previous 15 or 20 candles and all of that price action, which is really giving you all the things you need to know that this market is weak. You're not looking for long opportunities, you're looking for short opportunities. And in the space of about 3 or 4 hours, it was party time at the ranch.
It absolutely was, Ty. And this is where we want to give you the tip for, I guess, one of the best tips for today in terms of something that tends to work quite well at the correct areas. And that is that you get this rejection, but you actually want to see what we call momentum follow through. So as a day trader, you prefer to be in the momentum. Yeah, you don't want to be in like the chop, ideally. You want to be in, out relatively quickly. Some people call day trading scalping, etc. So we've got the retest. So we basically have resistance becoming support, and then it becomes resistance again over here. It's what they classically call role reversal. We have a pin bar rejection or shooting star, and then we have a follow through. So Tyron and I like to wait for that little bit extra kind of momentum towards the downside here. And when that occurs, usually it gets explosive. So we like to wait. You can wait for confirmation close underneath, or if you see the right setup, you're putting, your fibs in line, everything's working, you're moving averages, as Tyron mentioned, and then you get that follow through. I'd probably wait for it to go under this kind of level over here. And once that occurs, many people will start shorting it. You can see the power of the short, but you can also see how having confidence in your trade is really important, because what happens after that is it goes boom, full reversal, massive wick down. And for many people, it would have stopped them out here. So it's about getting that confidence drilled into you that you're seeing the right types of things. It's also kind of like right now, Ty, some people would say, oh, but we're kind of seeing a similar thing, Tom and Tyra, and we're seeing it over here. There's a few differentiations here. Number one, it's hit the trend line on the big time frames, which matter. Number two, it's above all the moving averages. And although this is a good looking short here, for us, if we came into this right now, we would always be looking for a little bit more information. Ty, we need this thing to close underneath, don't we?
Oh, 100%. And there's no way that you would be shorting there until it does that, because it has effectively got all of the things that you don't want behind it now. And that's what you have to actually go through to actually even start to make profit. It has to break 3 moving averages. It has to break effectively a role reversal zone. And and realistically, it's almost got an inverse head and shoulders that has to break down. So you've got to be very, very careful at this point here. Now, if it turns around, makes a series of lower highs and lower lows off this level and is trading below the moving averages again, happy days, no problem at all with that. But we've got to wait for that to happen. This is not one that you want to be preempting. And I think this is probably the important part of knowing which trades to actually, look for and which ones are setting up. And it's all important. I know we probably say it, time and time again, and you think, wow, you guys just repeat yourselves a lot, hey? But we do that for a reason, because it's just it's what we know works, and it's worked for a very, very long time, and it's not about to stop working anytime soon, because price action and momentum is everything in trading. So understanding the signs and being on the lookout. Hopefully everyone can understand that. I really hope that you can see why, although it may look and present like a good short, the obstacles in your way for that short can give you an awful lot of headaches, and that's not what you want to be trying to achieve in a day's worth of trading. Now, again, if it goes down below and makes a series of lower highs and lower lows, very, very different trade.
Now, Theo's brought up a great point, and as Tyrone said, there's different trades over here. You really only have the 200. That's it. Every single moving average was above, and price was looking super short. Over here, Theo says, I would rather look at longs around this zone because we've got so much moving average support. Yeah, exactly. I mean, you're coming off, if we're thinking about today, what have we seen? We've seen support, lightning bolt through on this one. Obviously, lightning bolt even stronger on the S&P 500 index. And then we have moving averages all sitting through this point. And we've got some kind of like rejection candles. And what this tells Tyrone and myself from a price action standpoint on the 2 hour here is that there are some sellers. Over here, there were sellers. Yep. Over here, there's sellers. If those sellers are taken out, Ty, what tends to happen? It gravitates to the next zone, doesn't it?
It does. It does. And the other thing that we need to be mindful of this at this level as well, and it answers the question from a little bit earlier. How do you incorporate volume to what you're actually seeing when you're trading? Well, that's another thing we've got to take a particular attention to here. As you can see, the price point where it's at now, the volume is lower here than it was before it broke out. So you can see, although price has made 3 peaks on the way to get up there, the volume peaks are actually getting lower and lower. So it's actually, although it has moved up, it's moved up on a lot less volume than when it was actually smashing down. So although that's not the be all and end all, it's certainly something that you need to be aware of. So that tells me that I wouldn't be rushing into a long either. I'm not shorting here, and I'm not longing. We need more information. Now, a break to the upside, increase in volume, lightning bolt up, happy days. It'll gravitate to the next level, up to 1495 or 15,000, wherever it wants to go. Or it makes a lightning bolt to the downside, and just as happy to trade either position, to be honest. I haven't really got a favor here. I think it can do either quite easily, but what you're not doing right now is actually placing a trade right now. Okay, that's the important part. Yeah. You're waiting for it to actually set up one way or the other. And when it does, you've got very clear targets either side.
And that's what you generally find coming into a market open. We talked about how it's really, really important to understand what times markets are opening. So if you're trading the US, obviously, where's the volume going to come in? The volume's going to come in half an hour before in the pre-market. These are obviously futures, so they'll trade all the time. And then you've got the market open. The first hour is usually, I call it the hour of power. It's the retail hour. It's where all the volume really comes in. So we'd expect a spike in volume and probably a closure either side, and then a follow through we would hope for. So yeah, I mean, there's just 2 ways to kind of look at it, and that's what a day trader has to be. You kind of have to be, very knowledgeable about all the time frames. 2 hours is definitely a great time frame. 1 hour is a great time frame. And you just want to keep breaking down these indices, breaking down the markets, and just having a look around to see the different opportunities, because there's always another opportunity. If you like also a specific sector and you like it during a period of time, again, that might be something that you target during a certain time. We saw biotech perform incredibly well over the period of, I guess, June. We saw hyper stocks, RK came back a little bit there. Now, of course, it's been more NASDAQ FANG stocks. So Pepperstone offers so many different chances to get into different ETFs.
Yeah, most definitely. Now, Dutch has brought up a question. How do you know that this is the right time frame to be looking at? Okay, so it is a good question. What you've got to consider when you're looking at the time frame that is relevant to what you're trying to achieve. Remember, this is all about day trading today. So we're looking at about the 1 hour, 15-minute, 2 hour time frames. We go to all of them, and we identify what's actually happening. They're the most relevant timeframes to what we're trying to achieve, because we're not looking for a trade that's going to last, a week or two. Okay. Now, and the other thing you got to remember too is, well, don't be fooled into thinking if you label yourself a day trader or a scalper that you have to actually be out in a matter of hours either, right? You don't want to get caught into that trap where you're putting pressure on yourself to actually get a result. Sometimes a trade goes overnight or a couple of days just simply because the market is moving a little bit slower, right? So you've got to go to the time frames. You look at the time frame, I look at the 1 hour and say to myself, all right, I'm going to, for the next 8 to 12 hours, I could get the result that I need quite easily, given what's happened in the past. So, you get a bit of a gauge by looking at the 1 hour or the 2 hour, or even the 4 hour in some instances, how far it can travel, where it needs to travel to keep it realistic for what you're trying to achieve. Now, a 1 hour and a 2 hour, look, they're great starting points for day traders. You can go as low as 15 minutes. That can give you some good clues as well. But it needs to be a meaningful time frame. And by that I mean, if you're a day trader and you're looking at a weekly setup and you're waiting for a weekly to break, well, that's just silly. Because that you're not going to get a trade in the time frame that you're looking for. So it's got to be relevant. You've got to be looking at a time frame that is going to give you a potential opportunity in the frame that you've given it. You've given it a day, you've given it 2 days, something like that. So yeah, and that's definitely start on the day. We always look at the daily no matter what. It doesn't matter whether we're scalping, day trading, whatever we're doing. We're always looking at the daily to give us our first, bias of what's actually happening, because that's the most important time frame in our opinion. And then you work it back. Then you go down to the 2 hour, 1 hour, and if you're really scalping, you go to 15 minute.
Yeah, breaking it down, bringing it back to the time frames, it's where it looks most clean to you that's really a big key. So I guess some takeaways for today is, of course, when you're looking for any trade in day trading, find at least 3 to 4 separate reasons to be in that trade. Always look for things like volume in indices. It's going to be very important, the time of the year that you're trading. And if you can bring actionable data together, which is something we definitely talk about a lot in our course and stuff, it's really, really important to do that. And we also want to bring in, because that's bringing in kind of like the facts. The data is the facts. I mean, data technically doesn't lie. It's just telling you the most obvious things that have happened over time. We want to bring in that price action whenever we can, and we want to understand the times of the day. So when we saw that NASDAQ before, it was kind of hovering within a zone. Ty was talking about different time frames. I ended up picking the 1 hour there. So I'll just quickly go back over to it actually. The reason why I picked the 1 hour over the 2 hour is because if we go to the 2 hour, you'll notice it's a very similar style, very similar. The 1 hour, like the smaller time frame that you use, the better, because of course you can, when you're talking about day trading, close confirmations and stuff, is that we've seen very similar wick rejections here with very similar candles. So I would say the bodies are kind of lining up around the same point. The 1 hour has this great 200 SMA above it. It's got, of course, the 20 underneath it, very similar kind of moving average set up to the 2 hour, makes sense. And if we get a closure above this point, I think it's really starting to signal that kind of further bullish momentum. And if we get a closure below, it's the same kind of thing, signaling that further bearish momentum. If you've got questions, please feel free to ask them through right now. We'd love to answer as many as we can. And yeah, I mean, it's an exciting time for indices over the next couple of years, and specifically picking sectors that you are passionate about, sectors that you like. I mean, some people just love Tesla and they just love trading Tesla, and that's fair to them. If you like specific, sectors of the market, such as biotechnology or healthcare or whatever else, Pepperstone's offering so many of those now. We definitely think they're worthwhile checking out and having a look at, because each will trade different throughout the year and each has its own unique opportunities.
Most definitely.
Yep, you want to answer that one, Ty?
Yes, Kelvin had asked, and it may be a question other people wanted to ask, how do you access the replay of this webinar? This webinar is recorded and it will be on the YouTube channel, on Pepperstone's YouTube channel tomorrow, and it will be on our private Discord room as well tomorrow as well. So the replay is always available. Yeah, and it will be there with you usually about 10 or 11 a.m. Melbourne time. But don't forget though, if you've missed any previous webinars as well, you can go through and catch up on them because they're always there. It's a very, very big, extensive library now, and we definitely talk about different things all the time. So don't be afraid to ever scroll through and look for the topic that you might be interested in. But this one will definitely be up tomorrow morning.
Some great helpful tools to people out there. You could always check out, if you like looking at sectors like this, you can check out maybe something like Koifin. which is just a good free resource for having a look at these kind of charts. This might give you an idea of the seasonals that you want to play out, or the things that you might want to focus on in the Pepperstone platform, and whether you like the biotech or you like the utilities right now or whatever else. You can bring up stuff like this, which is just like rotation over time. It shows here, of course, the technology sector, XLK, was the best performing, and the worst up until this point was energy. If you actually took the point from about November, Ty, all the way to most recently, one of the best performing sectors became energy. So when you can spot that, you can maybe go in there and find some opportunities that you might like. If you're a value player and you like the idea of day trading, an oil kind of move, or it's just so much open to you. And when you start to bring this through, it's great. So Ty, look, we'll answer these questions now, but I just thought I'd let everybody know, as we like to do, we do have a bit, if you're interested in kind of finding out more about some of the things we do here, we do have, I guess we'll call it the lockdown special, because if you don't know, Australia is in a decent amount of lockdown right now. You can go check us out at fxevolution.com. I'll put that in the room, and you can use coupon code July, and you'll be able to get 38% off. A pretty damn good course. Took us a long time to write that one, guys.
It's a very, very big course, and no doubt there's plenty of time in lockdown to be doing the course and actually learning how to trade. So we have got another question here from Johan. He is asking, do we use Fibonacci to determine our levels on the graph? Yes, we do. We don't always bring them up in terms of they just take too long. We try to get through a lot in these teaching webinars. We have had Fibonacci webinars where we've done the whole thing on Fibonacci, yeah, most definitely. Look, we do definitely use Fibonacci's. We don't use only Fibonacci. We use it as a tool to aid us in to pick the level. We don't always just go on Fibonacci level and say, okay, that'll do. But you're going to find that the majority of the time, when we're talking about the moves, we're naturally trained to identify levels, and they generally link up to a Fibonacci zone. So for us, we can put it on, but we kind of already know that it's there. But it's definitely something that you can apply to give yourself a bit more reassurance that it is a key zone, like a 38.2 or a 50% pullback. Very, very important. But yeah, we kind of know them automatically. And once you've done trading enough, you'll be in the same boat where you'll actually see the levels without even drawing the tool. So it's really, really important. Another announcement too I'm going to make, I know it is a little bit Pepperstone specific, because we are going to have a Pepperstone special guest. We have actually worked out that our inaugural conference, our FX Evolution conference, is actually happening in the last weekend, the last Friday and Saturday of October. So keep an eye out for announcements there. I know we're working with Pepperstone to potentially pull some deals together. I know Tarquin's going to be up there buying everybody drinks on the Pepperstone credit card, I believe. And we're hoping also to have our favorite person to come in and give us our fundamentals, Chris Weston, up there as well. So keep an eye out on that. We're working towards those dates, because we think we should be out of lockdown by then, and also summer will be kicking in as well. So the likelihood of being locked out of the state is less and less, but it is going to be up in Cairns. We have determined the date and we know where it's going to be. So definitely keep an eye out on that. I'm sure Pepperstone will make an announcement for a lot of the people out there as well. So we're really looking forward to that.
Here's a couple of questions coming in from Johan. We've got the ETFs and different stocks are not available on the Pepperstone MT4. Are they available on MT5? Yes, that is correct, Johan. You'll need the MT5 platform. Just quickly have a discussion with your Pepperstone support team, I guess, and they'll be able to go through that with you. But yeah, the MetaTrader 5 platform is the one that does have it. And we've got another question coming in here from Lazaro. He says, hello, do we have like a scalping strategy that always works on the NASDAQ? So always works is probably the look, you're never going to have something that always works. You're playing statistics at the end of the day. You're trying to stack your best statistics in your favor, and that's why we say you want 3 to 4 separate reasons. If you're thinking about scalping, you're thinking about applying some of these things, remember it's all about being able to see flow. So again, if you like to scalp, and that's something that you like, I would say that some things like understanding certain candles, such as, again, the pin bars or the hammers and shooting stars, engulfing candles, obviously VWAP can also be used, moving averages like we've been putting on here on the charts. These are all really great, and then you bring that together with your support resistance. So for an example here on the NASDAQ, we obviously know on the 5-minute chart, there is some decent support through this 14,701. So if we saw this come down, what Tyrone would generally, and I would look for, is we would look for symbols of potential recovery. So yesterday there was a great one here. You have a support, you have a support. Remember, it was previous support as well. It's effectively a double bottom pattern. It breaks through. It gives you a retest entry here, which is a conservative style scalping entry. And then of course it goes up, and you would basically be in here. You would take the distance of this double bottom and you'd be out here. That's a simple kind of concept. You're going with the trend. And I think one thing that scalpers fall into the problem is that they don't go with the trend. They tend to be like, I'm going to short this all the way down to here, don't they, Ty? I'm gonna kick the market's ass, I guess. But the problem is that the reality of the situation is ultimately you want to know, where is the daily trend? What are you looking at? And when you bring the daily down into the 4 hour, down into the 1 hour, down to the 5 minute, once you've got that daily trend and possibly the actionable data in your favor as well for that month being a bullish month, you can bring all of that together to give yourself more bias towards the buy side. Remember, market indices, even ETFs, most ETFs in general are bullish style investments. The market, as a general term, does go up over a 10, 20, 30-year span.
Yeah. When you're trading, you don't want to fight the Fed. You don't want to fight the trend.
Nope.
You don't want to ideally counter trend unless it's to a pullback to actually join an existing trend. And I think it's probably the number one rule on counter trending. Only do it when it actually coincides with joining an existing trend at the end point. And I think that's probably really important. If you follow those simple rules, day trading and scalping can be a hell of a lot easier than actually not following them. That we can certainly assure you. So, okay. So look, thank you everyone for joining us tonight. We've really enjoyed doing ETFs. We love them. We love them because actually technical analysis makes sense no matter what you're doing. The same setups we talk about in currencies work exactly the same way in indices and in ETFs. Now, we have a live webinar starting in our YouTube channel in 10 minutes. If you want to see the live market analysis, you can definitely join that for free. Thomas will point the link in for you to join that webinar. Also, we've got a survey at the end of this webinar to hopefully you guys can take a minute of your time to fill it out. Let us know how we can help you better, what you want to see, what you're not seeing. We really want to make these webinars as good as possible for you, of course. We do them every fortnight, but it's really important information for both us and Pepperstone to know, so we can really tailor them to give you, or so you can get the most out of them, because we're really here for you. So please take a moment to fill that out, and we'll try and bring you the best content available, given what you're after.
All right, guys, thank you so much for joining us. We might see you very soon, or otherwise we'll see you hopefully in 2 weeks, and we wish you the best out there in the markets and navigating them. Bye for now.
Thanks, everyone. Good night.